Hi everybody, this is a quick video to explain to you about how the recent rise in the rate of interest might impact you. Don't forget to subscribe so that you know when there are new videos coming up on Ingonomics. So to start off with, the interest rate is also called the base rate in the UK, and it's set by the Monetary Policy Committee of the Bank of England, and they'll refer to it as the base rate or the interest rate. And this rate affects the interest rates that are charged by banks or that you earn when you have savings in a bank account. And recently they announced that this was going to go from 0.1% up to 0.25%. And always remember, there are three ways that you can be affected by the rate of interest. If you think of it like this, rate of interest, there are three things. One is if you're saving. One is if you take a loan out. And the third one is if you have an existing loan. So there are three things: rate of interest, saving, taking out a loan, or if you have an existing loan. And also, another important thing to know about the rate of interest, it depends whether the rate which you're looking at in relation to your saving or your loan is a fixed rate, or it may be a variable rate. If you have a fixed rate on your savings or loan, that means that the rate of interest that you receive or you're paying is fixed for a certain amount of time, maybe a year or 2 years. If you have a variable rate of interest on your loan or your savings, that means that the rate of interest that you are receiving or paying is changing when the base rate changes. And therefore, if you have an existing loan which has a variable rate of interest on it, that will mean that when the base rate went up, you'll now have to pay more interest on your loan. So now let's break it down, the impact depending on whether you're a saver or you're a borrower. If you're a saver, you have money in the bank and you earn interest on your savings. That means that you put your money in the bank and the bank give you money as a reward for saving your money with them. And if you've got money in the bank and it's got a variable rate, this will probably mean, not always, but it will often mean that the amount of interest that you're receiving is going to go up. So your interest will go up if the rate that you're receiving on your interest is now higher. And when you have your savings, you'll be receiving X% of your savings as interest. And we can see an example here. In the past, when the interest rate was 0.1% of, let's imagine that you were saving £1,000 in the bank. And that works out as £1 interest. 0.1% of £1,000 is £1. If, however, the rate of interest is 0.25% of £1,000, now you would be earning £2.50 interest. And usually this is applied per annum or per year. So you can see that over the year, you wouldn't be earning £1 interest, now you'd be earning £2.50 interest. This doesn't seem like a big difference, and that's because they're quite low interest rates, and it's just on £1,000. But if somebody's saving more than £1,000 in the bank, this starts to be a bigger difference and bigger amounts of money, so it has more of an impact. So that's if you're a saver. What about if you're a borrower? So maybe you want to take out a loan. And if you take out a loan, you must pay interest to the bank on your loan. It's effectively how much it costs to borrow money. So for example, maybe you take out a loan and you're paying 4% and you take out a loan of £1,000. In this case, to work out the interest, you'd need to do 4% of £1,000. And that's equal to £40. And that, again, is likely to be per annum. So you're paying £40 interest per year. Now, with the increase in the base rate, if your loan is on a variable interest rate, now the rate of interest that you pay may go up to 4.15% times £1,000. And that will mean that now you're paying £41.50 per year in interest. Again, this doesn't seem like a big increase. It's only £1.50 in the whole year. However, it might be that you want to take out a much bigger loan than £1,000, and you can calculate for yourself the difference, because what's happened with the interest rate is now 0.15 higher. So instead of it being 4%, it would be 4.15%, and you can work that out with any other situation. So this is if you wanted to take out a new loan. The final situation is if you have an existing loan. Lots of people in the UK have a mortgage to buy a house. So they have a mortgage at the moment over their house. And this means that they're paying interest every month on the amount that they've borrowed to buy their house. And if their mortgage is on a variable rate, it's likely that the amount of interest that they pay every month is going to increase because the base rate has increased. So let's imagine that the person was paying 5% interest on their mortgage of £250,000. That would mean that every year they'd be paying £12,500 interest per year. Now, because of the increase in the base rate, they may well have to pay 5.15% of the £250,000 that they've borrowed on their mortgage. And this would equal £12,875. So you can see that for someone on a variable interest rate, the base rate increase is going to mean that now they're having to pay more money per year. You can do any of these calculations for yourself just by finding out if your interest rate has changed. You can ask the bank about that and they'll tell you. And if it has, you can then just work out the amount %, so the percentage, times the amount that you have borrowed from the bank. And then you can see how much this will change over a year. And then you could divide that by 12 to see how much you're now having to pay every month.